Welcome to this short e-learning on yield curves, which are graphical representations of the relationship between maturity and interest rates, or yields. In this e-learning, you will learn how to interpret the shape of a yield curve and the possible changes in it. Based on collected available market information, this example graph of the daily Treasury yield curve reflects the average interest rate that the U.S. government had to pay to borrow funds on 13th of May in 2018 for maturities up to 30 years. Please note that non-government U.S. borrowers will have to pay higher rates depending on the assessed additional credit risk by lenders. This graph illustrates an upward slope, a rising yield curve, where interest rates for longer periods are higher than those for shorter periods. The normal shape of a yield curve has an upward slope. Generally, the yield increases are bigger for short compared to long maturities. This is illustrated by the steep and flattening part of the normal yield curve graph. There are several theories that explain the yield curve shape and changes. For example, according to the liquidity preference theory of Maynard Keynes, investors require a higher yield for longer periods as compensation for not being able to use the funds on the short term. It is logic that investors want a compensation to postpone spending money. But there are more explanations for higher long-term rates, such as an additional compensation for the higher risks of unexpected events, a higher exposure to counterparty default, and increasing inflation. On financial markets, the interest rates change constantly. Interest rate changes can be caused by many factors, such as supply and demand of capital, economic developments, and central bank interventions. This causes the yield curve to flatten or to steepen, or to shift parallel up or down. Steepening can be caused by long-term interest rates increasing more than short-term rates, or long-term rates decreasing less than short-term rates. Flattening can be the result of long-term interest rates decreasing more than short-term rates, or long-term rates increasing less than short-term rates. It does not happen often, but market stress conditions, such as the 2008 credit crisis, can even create a downward slope, an inverse yield curve, where short-term yields are higher than long-term. Another influence that can cause changing yield is the expectation about future interest rates of market participants. This expectation about future interest rates can be derived from the current yields by calculation of the forward yields. The pure expectations theory assumes that the market yields are based on the expected future interest rates, the forward rates. This example explains how to calculate the expected forward rate using a simple method. This method is not completely correct, but is sufficient for now. Suppose that the current interest rates, the spot rates, are 2% for 3 months and 2.5% for 6 months. The pure expectations theory assumes that these spot rates are based on the market expectation that the 3-month forward rate after 3 months will be 3%. In market jargon, this is known as the implied forward rate, or the 3s versus 6s forward. The 3s versus 6s is the forward for a period starting after 3 months and ending after 6 months from spot start date. Another example is that a 4s versus 9s forward expresses the 5-month implied forward rate after 4 months from spot. The pure expectations theory says that if market expectations change, the spot yields will change. Changes in the yield curve can be caused by changes in market expectations about future spot rates. Because forward rates can be calculated from the spot rates, as illustrated in the graph, a forward yield curve can be derived from the spot rate yield curve. If a spot rate yield curve steepens, the forward yield curve will also steepen. According to the pure expectations theory, this implies that market participants expect future spot rates to increase. If the spot rate yield curve flattens, the average market expectation is a decrease of future spot rates. Of course, This does not mean that the market expectation will actually materialize in the future. The market is dynamic and yields shift all the time. There is much more to learn about how financial institutions analyze and interpret the yield curve to manage their operations. This short video shows how we make complex finance easy to understand. Feel free to explore our affordable Udemy e-learning courses and continue learning at your own pace. Our financial programs are designed for you because finance does not have to be complicated. It is not rocket science. At the Financial Training Hub, we create classroom and e-learning courses that make finance simple, practical, and accessible. Please feel free to contact me for tailored classroom and e-learning programs, or if you would like any further information. Thank you for watching this video.